You come to me because you are desperate, because you are confused, and because you have realized that the modern world is a cesspool of asininity that is rapidly eroding your capital and your sanity. You want the secret sauce, the magic bullet, the own weird trick to recover from disaster. Let me tell you straight out, you are looking for the wrong thing. The delusional belief that permeates your generation, this grotesque notion that you can fail your way to success, or that hitting rock bottom is some sort of romantic prerequisite for glory, is absolute rat poison. It is a lie sold to you by people who make money selling courses on resilience to idiots who have no business taking risks in the first place. I lost everything at 29 years old. I was divorced, broke, grief-stricken, and walking the streets of Pasadena in a cheap suit looking at the pavement because I couldn't bear to look at the sky. It wasn't a learning experience I would wish on my worst enemy. It was a Lollapalooza of misery. The idea that you should embrace risk to get rich is the sort of madness that gets you wiped out. The only thing that saved me, the only thing that pulled me out of that hole and put me on the path to where I am now was not a sudden stroke of genius or a gamble on a hot stock. It was the complete and total rejection of stupidity. It was inversion. Most of you are trying to be brilliant, and that is why you are failing. You are trying to find the needle in the haystack, the 10-bagger, the next Amazon, while you are drowning in credit card debt and emotional fragility. It is pathetic. You are playing a game you cannot win against people who have better information, faster computers, and fewer scruples than you do. When I was young, I looked at the great men of the past, the Rockefellers, the Carnegies, the men who built the railroads and the steel mills. They didn't operate with this frantic, twitchy, dopamine-addicted energy that I see in the markets today. They were like glaciers. They moved slowly. They crushed everything in their path, and they were inevitable. They didn't try to be smart. They tried to be consistently not stupid. There is a profound difference. As I said at the 2003 Wesco annual meeting, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. There must be some wisdom in the folk saying, it's the strong swimmers who drown. You think you are a strong swimmer because you read a Reddit thread and open a brokerage account. You are not. You are a minnow swimming into the mouth of a shark. And you are applauding yourself for your bravery while you are being digested. Inversion is not just a cute mental trick. It is the fundamental law of survival. The mathematician Carl Jacobi said, invert, always invert. He knew that many hard problems are best solved when they are addressed backward. You want to help India. Do not ask, how can I help India? Ask, what is doing the worst damage to India? And stop doing that. You want to be rich. Do not ask, how do I make $1 billion? Ask, what will ensure I die poor and miserable? And then avoid those things like the plague. It is simple, yet you refuse to do it because it is not sexy. It does not stroke your ego. Avoiding stupidity is boring. It requires patience. It requires you to sit on your ass and do nothing for years at a time while your idiot neighbor gets rich on some cryptocurrency Ponzi scheme. But let me tell you, the tortoise wins because the hare is an undisciplined fool who eventually blows himself up. The modern world is full of hares. It is full of people who are leveraged to the hilt, chasing yield, trying to force the market to give them a return that they have not earned. They are operating on hope, and hope is not an investment strategy. It is a defect. Let's talk about the old world versus this modern asylum. In the early days of Berkshire Hathaway, and even before that at the Wheeler-Munger partnership, we didn't buy things because they were popular. We bought them because they were disgusting to everyone else, but mathematically certain to pay out. We looked for cigar butts, companies that were ugly, cheap, and had one good puff left in them. We didn't care about the narrative. We didn't care about the vision. We cared about the cash flow and the liquidation value. Compare that to today. You have companies trading at 50 times revenue, not earnings, revenue, and you have people buying them because tech is the future. This is folly. This is the sort of mass delusion that Charles Mackay wrote about in Extraordinary Popular Delusions and the Madness of Crowds. You are all participating in a tulip mania, but you have convinced yourselves it is a paradigm shift. It is not. It is just greed masquerading as innovation. At the Daily Journal meeting in 2019, I called Bitcoin rat poison squared, and I meant it. It is a trade in nothing dependent on the greater fool theory. If you're buying things hoping to sell them to someone stupider than you are not an investor, you are a gambler, and the house will eventually take your chips. I am not your advisor. But if I were, I would tell you to consider stopping the bleeding before you try to start the healing. You cannot compound wealth if you are compounding mistakes. The first rule of compounding is to never interrupt it unnecessarily, yet you interrupt it every day with your hyperactivity. You buy, you sell, you react to the news. You listen to the talking heads on television who are paid to keep you agitated. You are running on a treadmill of fees and taxes and anxiety. Stop it. Invert the problem. What destroys wealth? High fees? Frequent trading, leverage, envy, chasing trends. If you simply eliminated those 5 things from your life, you would be ahead of 99% of the population. You don't need to be a genius. You just need to control your primitive urges. The human mind is not designed for the stock market. It is designed for the savannah. It is designed to run from danger and chase food. In the market, running from danger usually means selling at the bottom, and chasing food means buying at the top. You have to train yourself to do the opposite. You have to be a contrarian not for the sake of it, but because the crowd is usually driven by emotion, and emotion is the enemy of rationality. Let me give you a specific example of how failing to invert cost me a fortune. It is a mistake that still grinds on me even at 99. It was the 1970s. I had the opportunity to buy a massive stake in Belridge Oil. It was a clear bonanza. The underlying value was obvious. The reserves were there. The management was decent. It was trading at a price that was essentially a gift. I bought some. I bought a lot, actually. But I didn't buy as much as I should have. Why? Because the price rose slightly while I was buying. I wanted it at my price. I was being a cheapskate. I was pinching pennies while dollars were flying over my head. I had a mental block that said, I won't pay up even a little bit. I failed to invert. I failed to ask, what is the cost of not buying this? The cost of not buying it was missing out on billions of dollars when Shell Oil eventually acquired it. It was a mistake of omission, not commission. It doesn't show up on a balance sheet, but it is there in my head. I was too clever for my own good. I let a triviality, a slight increase in price, block me from a Lollapalooza outcome. That is the danger of ego. I thought I could dictate terms to the market. You cannot. You take what the market gives you, and when it gives you a fat pitch, you swing with everything you have. I swung with half a bat. It was asinine. The one thing that saved me at 29 was the realization that I was not smart enough to predict the future, but I was disciplined enough to prepare for it. I stopped trying to predict interest rates. I stopped trying to predict the macroeconomy. I focused entirely on what I could control, my own temperament and the specific valuation of the businesses I looked at. I looked for things that couldn't fail. I looked for businesses with moats so deep and wide that an idiot could run them. Because eventually one will. This is the essence of avoidance. You avoid the businesses that require a genius to manage. You avoid the situations that require perfect execution. You look for the no-brainers. If you have to use a complex spreadsheet to justify an investment, it is not a good investment. The best ideas are simple. They scream at you. But you can't hear them if you are listening to the noise of the crowd. You have to shut up, sit down, and read. I have said it 1,000 times in my whole life. I have known no wise people who didn't read all the time, none, zero. You think you can get by watching 3-minute videos? You are deluding yourself. Inversion applies to your personal life just as much as your portfolio. You want a good life. Invert, you guarantee a miserable life. Be unreliable. Be resentful. Be envious. Succumb to addiction. If you do those things, I guarantee you will be miserable, no matter how much money you make. Envy is the stupidest of the 7 deadly sins because it's the only one you don't have any fun at. It's just pure pain. Yet the entire modern economy is built on manufacturing envy, Instagram, TikTok, luxury advertising. It is all designed to make you feel inadequate, so you will buy things you don't need with money you don't have to impress people you don't like. It is a treadmill to hell. Step off it. When I was young, nobody cared if you got rich slowly. Now, if you aren't a millionaire by 25, you think you're a failure. This impatience is destructive. It leads to leverage, and leverage is the only way a smart guy can go broke. As I told the shareholders at the 2010 meeting, there are 3 ways a smart person can go broke: liquor, ladies, and leverage. The first 2 are just for fun, but the third one is pure folly. You need to understand that the game is rigged against the impatient. The market is a device for transferring money from the impatient to the patient. That is a quote often attributed to Buffett, but it is standard doctrine in our world. If you cannot watch your portfolio drop 50% without panic, you should not be in the stock market. You will panic, you will sell, and you will lock in your loss. That is the definition of stupidity. You are reacting to price, not value. Inversion teaches you to look at a 50% drop not as a disaster, but as a sale. If you like the stock at 100, you should love it at 50, provided the fundamentals haven't changed. But you don't. You hate it at 50 because the crowd hates it. You are a social animal, and social proof is a powerful drug. You have to detox. You have to become comfortable standing alone. It is lonely to be rational. It is lonely to sit on cash when everyone else is partying. But when the music stops, and it always stops, you will be the only one with a chair. The modern fool looks at a problem and asks, what is the upside? The wise man looks at a problem and asks, what is the downside? If the downside is ruin, I don't care what the upside is. I am not interested. I have no desire to go back to being 29 and broke. I have structured my life to ensure that never happens. This is why I speak so harshly about Bitcoin and crypto. It is not because I am an old man yelling at clouds. It is because I see a generation walking blindfolded into a minefield. You are buying unproductive assets. Gold has the same problem, but at least gold has thousands of years of history. Crypto is a specialized form of gambling that consumes electricity and produces nothing but volatility. It is contrary to the interests of civilization. To touch it is to dirty your hands with folly. You call it the future, I call it open sewage. Avoid it. Invert the desire to be part of the movement and realize that the movement is a cliff. So here is the lesson of the first block. If you have the attention span to grasp it, stop trying to win. Start trying not to lose. List every possible way you can screw up your financial future. Write it down. Debt, options trading, listening to tips, buying high, flying tech stocks with no earnings, trusting people with polished teeth and no track record. Make the list and then vow to never do anything on that list. If you do that, you will win by default. You will be the last man standing. It is not glorious. It will not get you likes on social media, but it will get you rich, and more importantly, it will keep you free. And that, my friends, is the only thing that matters. The rest is just noise and vanity. Now sit there and think about how many times you have violated these simple rules in the last month alone. I bet it is a lollapalooza of a number. You think you have time. This is the most dangerous illusion of youth and the most tragic realization of age. You look at a calendar and see a vast expanse of empty days stretching out before you, a blank check of existence that you can squander on trial and error. You are wrong. You are decaying meat. From the moment you are born, you are a depreciating asset in terms of biological vitality, and the only way to offset that decay is through the accumulation of wisdom and capital. But here is the brutal math that your teachers never taught you because they were too busy trying to make you feel good about yourselves. Compounding requires a long runway. If you waste your 20s and 30s finding yourself or chasing mediocre returns, you are not just losing the money you didn't make in those years, you are lopping off the exponential tail of the curve that occurs 50 years from now. You are killing the goose before it has even laid an egg. Time is the one asset you cannot buy, you cannot invert, and you cannot hedge. It flows in one direction toward the grave. Every day you spend holding a subpar investment or tolerating a subpar career is a day you have stolen from your future self. It is an act of theft. When I look at the modern investor, I see a frantic squirrel burying nuts in random holes, forgetting where they are and running into traffic. You are busy. You are active. You are trading options on your phone while you are on the toilet. You feel productive. But activity is not achievement. In fact, in the investment world, activity is usually the enemy of achievement. You are paying taxes, you are paying spreads, and you are interrupting the compounding process. You are treating time as if it were infinite, swinging at every pitch that comes across the plate because you are bored. Boredom is not a reason to invest. Boredom is a signal that you should go read a book. The great samurai Miyamoto Musashi said, "The only reason a warrior is alive is to fight, and the only reason a warrior fights is to win." In our world, allocate capital is to generate a return that exceeds your opportunity cost. If you are not doing that, you are just masturbating with money. You need to understand that doing nothing is a decision. Holding cash is a decision. And often it is the most intelligent decision you can make, provided you have the discipline to strike like a cobra when the moment is right. But you don't. You strike like a blind man flailing a cane, hitting nothing but your own ankles. This brings us to the algebra of opportunity, a concept so simple that only a PhD in economics could fail to understand it. Life is a series of opportunity costs. Everything you do is a trade-off. If you marry the wrong person, the opportunity cost is the right person you didn't meet because you were too busy being miserable. If you buy a stock that returns 10% when you could have bought one that returns 20%, you haven't made money. You have lost the difference. This is the filter through which you must view the world. Most people look at an investment and ask, is this good? That is the wrong question. The right question is this better than my best alternative? If I have a guaranteed idea that will make me 15% with zero risk, why in God's name would I look at a speculation that might make 20% with a 50% chance of ruin? It is asinine. Yet you do it every day. You diversify into your 10th best idea because you read somewhere that diversification is prudent. I have news for you. Diversification is for idiots. It is a hedge against ignorance. If you know what you are doing, you don't need to own 50 stocks. You need to own 3, maybe 4. I have spent my life trying to discard everything that didn't meet my hurdle rate. And my hurdle rate is simply my best idea. If I have a great idea, let's say buying Berkshire stock in the early days, then every other potential investment must be measured against that. If it's not better than Berkshire, I don't buy it. I discard it. I throw it on the scrap heap of history. This simplifies life tremendously. You don't need to analyze 5,000 companies. You just need to find one Lollapalooza and then compare everything else to it. If you can't beat it, you put your money in the Lollapalooza and go play bridge. This is the fat pitch theory that I borrowed from Ted Williams. Ted Williams was the greatest hitter who ever lived because he waited. He carved the strike zone into 77 cells, each the size of a baseball. He knew that if he swung at a ball in his happy zone, he would bat 400. If he swung at a ball on the lower outside corner, he would bat 230. So he didn't swing. He let the balls fly by. The fans booed. The pitchers taunted. He didn't care. He waited for the fat pitch. In the investment world, there are no called strikes. You can stand at the plate for 10 years with the bat on your shoulder, and the market can throw you Tesla and Nvidia and Bitcoin, and you can just watch them go by. You don't strike out until you swing and miss. But you have no patience. You feel the itch. The money is burning a hole in your pocket. You see your neighbor buying a new boat because he got lucky on a meme stock, and you think, I need to get in on the action. That is envy driving your bus, and envy is a drunk driver. You swing at the low outside corner because you are desperate for a hit, and you ground out to second base. You have just wasted capital, and more importantly, you have wasted time. You have locked your money into a mediocre position, which means when the true fat pitch finally comes, when the market crashes and quality is selling for pennies, you have no cash to swing with. You are fully invested in garbage. This is the tragedy of the modern retail investor. You are always fully invested, usually in things you don't understand. At the exact moment you should be sitting on a pile of cash big enough to choke a hippopotamus. You must learn to sit. You must learn to wait. You must learn that doing nothing is the hardest work of all because it requires you to fight your own biology. Now, I spoke in the previous block about my error with Belridge Oil, a classic case of pinching pennies. But if we are talking about the true gut-wrenching cost of missed opportunities, I must confess a sin of omission that dwarfs Belridge. It is a mistake that has cost me billions, yes, billions with a B. It was the failure to buy Walmart. I want you to understand the magnitude of this stupidity. It was the 1970s. I knew the retail business. I knew what Sam Walton was doing. It was not a secret. He was taking a chainsaw to the cost structure of retail. He was efficient, he was ruthless, and he was expanding in a way that was mathematically inevitable. I saw it. I admired it, I understood it, and I did nothing. I sucked my thumb. I looked at the price and thought, it's a bit rich. I thought, maybe I'll wait for a pullback. I was trying to be clever. I was trying to time the entry. The year was roughly 1974. I could have bought a substantial stake. I had the capital, I had the knowledge. I simply lacked the aggression to act on my conviction because the PDE ratio was a little higher than I liked. I was anchored to the idea of buying things for less than liquidation value, the old Ben Graham cigar butt style. I hadn't yet fully evolved to the idea that a great business at a fair price is better than a fair business at a great price. I let Walmart go. I watched it split and split and split again. I watched Sam Walton become the richest man in America. I watched the Walton heirs become a dynasty, and I owned zero, the consequence. I missed out on a return that would have added billions to my net worth. I missed out on the easiest money in the history of capitalism. All I had to do was buy it and go to sleep for 40 years. This is the mistake of omission. It doesn't show up in your tax returns. Your accountant won't see it. But it is the most expensive mistake you will ever make. You worry about losing 5,000 on a bad trade. I worry about missing the 50 million gain because I was too busy worrying about the $5, and you are stepping over dollars to pick up dimes. You are obsessing over the downside of a clear winner because you are scared. Fear is just as destructive as greed. When the odds are heavily in your favor, when the math is screaming at you, you must bet heavily. As I said at the Daily Journal meeting, when you have an edge, you should bet heavily. But you don't. You bet small on your best ideas and big on your worst ones. You dilute your winners. You sell your winners to buy losers because you want to lock in profits. That is like cutting the flowers to water the weeds. It is madness. The algebra of opportunity demands that you recognize the rarity of greatness. Great businesses are rare. Great management teams are rare. Great entry points are rare. When you see one, you cannot approach it with a teaspoon. You must approach it with a bucket. You must be prepared to look foolish to the crowd. When I passed on Walmart, I didn't look foolish. I looked prudent. I looked conservative. But in reality, I was being reckless with my future potential. I was prioritizing the comfort of a safe price over the reality of a compounding machine. Do not make this mistake. Do not let a valuation metric blind you to the inevitability of a business. If you find a business that has a high return on capital and can reinvest that capital at the same high rate for decades, you pay the price. You buy it, you sit on it, you don't trade it. You have to understand that your lifetime results will be determined by fewer than 10 decisions. That's it. 10. If you take the top 10 investments out of Berkshire's history, we are average. We are a joke. All of that wealth, all of that reputation comes from a handful of moments where we stepped up and swung hard. The rest of the time, we were sitting on our hands, we were reading newspapers, we were drinking Coke, we were doing nothing. But that nothing was active waiting. We were like a tiger in the grass. A tiger doesn't run around the jungle all day chasing mice. It conserves energy, and when the big game walks by, it explodes. You are running around chasing mice. You are exhausted. You are stressed, and you are starving. Stop chasing mice. Inversion teaches us here, too. How do you destroy your returns? By selling your winners too early, by buying your losers too late, by churning your portfolio, by paying attention to the noise. If you want to win, you must invert your behavior. Be lazy. Be lethargic. Be incredibly picky. Act like you have a punch card with only 20 punches in it for your entire life. If you knew you could only make 20 investments between now and the day you die, would you have bought that garbage crypto coin last week? Would you be trading options? No. You would be researching. You would be thinking. You would be waiting. And when you finally punched the card, you would make sure it was a Lollapalooza. Treat your capital with that level of respect. It is your life energy. It is your freedom. Do not squander it on boredom. The clock is ticking. You are older than you were when you started reading this. The compounding curve is getting shorter. You do not have the luxury of another decade of stupidity. You must stop acting like a child in a candy store and start acting like a predator in a resource-scarce environment. The fat pitch will come. It might come tomorrow. It might come in 3 years. But if you are broke because you gambled on nonsense, or if you are distracted because you are drowning in 100 mediocre positions, you will miss it. and missing it is the sin for which the market offers no forgiveness. You will simply fade away, a footnote in the history of capital, a man who had the opportunity to be great but chose to be busy instead. Don't be busy. Be right, and when you are right, be heavy. You are drowning in information, and yet you are starving for wisdom. This is the paradox of the digital age. You have a supercomputer in your pocket that gives you access to every financial statement ever filed, every annual report ever written, and every lecture ever given. And what do you use it for? You use it to listen to charlatans. You use it to watch 20-year-old experts in rented Lamborghinis tell you how to get rich quick. You tune in to the financial news networks where men in expensive suits shout at each other about what the Federal Reserve might do next Tuesday. Let me tell you something about these people. They are chaffiers. Max Planck, the Nobel Prize-winning physicist, once told a story about his chaffier. The chaffier had heard Planck give the same lecture on quantum mechanics so many times that he memorized it. One day he asked Planck if he could deliver the lecture himself. Planck agreed and sat in the audience in a chaffier's cap. The driver gave the lecture perfectly, but when a physicist in the back asked a probing question, the chaffier was stumped. He had the vocabulary, but he didn't have the knowledge. The world is full of chaffier knowledge. The talking heads on television, the YouTubers with the shocked faces in their thumbnails, the Twitter gurus, they are all chaffiers. They know the words. They can say EBITDA and Fibonacci retracement and yield curve inversion, but they don't know anything. They are mimicking competence. They are actors playing the role of investors. If you step outside your circle of competence, you will be slaughtered. This is a concept I have hammered on for decades, and yet you ignore it because you think you are smart enough to learn anything in a weekend. You are not. I am not. Warren is not. We stay in our circle. We know what we know, and more importantly, we know what we don't know. I don't invest in high-tech biopharmaceuticals because I don't understand the science. I don't invest in the fashion industry because I don't understand the whims of teenagers. I invest in things I can understand: banks, railroads, energy, consumer staples, simple businesses, boring businesses. You, on the other hand, are investing in decentralized finance protocols and AI startups and lithium mining in countries you can't find on a map. You are gambling on things you cannot possibly evaluate. You are relying on the chaffiers to tell you it's a good idea. And when the music stops, the chaffer will still have his salary, but you will have lost your capital. You must learn to ignore the noise. If someone is on TV shouting about a stock, it is already too late. If your Uber driver is giving you crypto tips, it is time to sell. You must build a fortress around your mind and only let in information that is verifiable, factual, and relevant to your specific circle of competence. If you don't have a circle of competence, admit it. Start with an index fund. There is no shame in knowing you don't know. The shame is in pretending you do. Trust is the currency of civilization, and it is the bedrock of wealth. But trust must be earned, and it must be verified. In the modern world, trust is broken. You trust platforms that sell your data. You trust influencers who are paid to dump tokens on you. You trust CEOs who are compensated in stock options and have every incentive to lie to you about the next quarter. You need to develop a nose for integrity. In my career, I have done deals with a handshake. I have done deals where the contract was a formality because I knew the man on the other side was a person of honor. If you find yourself in a deal where you need a 100-page contract to protect yourself, you are in the wrong deal with the wrong person. You cannot write a contract tight enough to protect you from a crook. A crook will find a way to cheat you. A fool will find a way to lose your money. You must avoid both. As this goes back to inversion, don't ask, is this a good contract? Ask, is this a person I would trust with my wallet if I were in a coma? If the answer is no, walk away. I don't care how good the numbers look. Character is destiny. In business, in marriage, in friendship, character is the only leading indicator that matters. Now, let us distill everything down to the absolute essentials. You want a roadmap. You want to know how to navigate this minefield without blowing your legs off. It comes down to VARs, the 3 decisions that you must make, and you must make them with the rigidity of a religious zealot. First, you must live below your means. This is not about deprivation. it is about freedom. If you spend everything you make, you are a slave. You are a slave to your boss, a slave to the bank, and a slave to the economy. If you save, you buy your freedom. Second, you must never interrupt compounding. This means you do not sell during a panic. You do not pull money out to buy a boat. You do not touch the principal. You let the snowball roll. If you interrupt it, you reset the clock and you will never catch up. Third, and perhaps most importantly, you must remove toxic people from your life. I am talking about the pessimists, the gamblers, the envious, the unreliable. These people are anchors. They will drag you down. They will infect your mind with their rot. Cut them loose. It sounds harsh. It is harsh. But if you want to soar, you cannot carry dead weight.